Good afternoon or evening. I suppose it depends on when you're watching this video. My name is Jon Glougie, and I'm an advisor with Left Financial Hollis Wealth, and I'm here today to talk to you about death and taxes. So in answer to your first question, I am indeed the most lonely person in our office. Nobody wants to talk about death and taxes, but it's important. Why? Because they're the two guarantees in life. And taxes in Canada are confusing as it is, right? While we're young, we're working, we're earning income. We have a graduated tax system that can be kind of convoluted, hard to understand. It doesn't get much easier when you pass on and you try to leave your estate to your beneficiaries. So today we want to maybe look at a few simple estates and see how they're taxed, just to make sure that we're planting some seeds with everybody so that when it comes time to do your will, your estate plan, you've got some of this baseline knowledge that you can apply to your own situation. You ever think about your taxes and end up looking like this guy? That's okay. Like I say, they are kind of confusing and convoluted here in Canada. So that's why we're going to do this webinar today, just to make sure that we can add a little bit of clarity for those who need it. So when we're thinking about our estate plan, we're thinking about how we want to leave our stuff to everybody when we pass on. A lot of that can be done through a will. So it's very important to have an updated will at all times. Of course, a will alone cannot really necessarily help you with the estate tax bill. So instead of necessarily only asking ourselves, how can my stuff get taxed? We should maybe think about asking ourselves a second follow-up question. Who do you want to name as your beneficiary, or who do you want to get all your stuff? That's the more important question. So is it the CRA or is it someone that you love? It's likely going to be a smattering of both, but let's just make sure the ones that we love in this slide, the little monkeys in the top right there, let's make sure they're the ones that are getting looked after. So let's look at a very simple estate. 4 assets, really. In this example, we have a couple, both passed on. They have a principal residence worth $500,000, so clearly it's not in Vancouver. They have an RSP account combined of a little over $500,000. They have TFSA accounts, combined at $100,000, and non-registered accounts combined at $150,000. We're making the assumption that the non-registered accounts were originally invested at $75,000 and have appreciated to $150,000 over the years. All in all, we have 4 assets effectively that are making up this estate, and it makes the estate worth $1.3 million. And as you can see below that, upon the passing of the second spouse, that estate will be facing a tax bill of $280,000, not including probate. We'll get into probate in a second. Where does this 280 even come from? It is identified, but let's go through it. Number 1, the principal residence. That has a principal residence exemption, so there is no estate tax payable on that. It is subject to probate, but no estate tax payable. The RSPs, $550,000. Those will transfer, the $550,000 will transfer directly to a beneficiary or beneficiaries of their choice. However, it does create a tax liability of $262,350. Where did that come from? Well, with the RSP, unfortunately, in the year of the second spouse passing, $550,000 will need to be considered income for that person in that year. And $550,000 of income is going to push any Canadian into the highest marginal tax bracket. So while the beneficiaries do get the full $550,000, it's up to the estate to settle the tax bill of $262,000. The tax-free savings accounts, those are tax-free and they have named beneficiaries, so those can pass on to the beneficiaries outside of the will, outside of the estate, no tax payable, no probate. That's why they're so wonderful. And the non-registered accounts. The reason that we made the assumption that they were first invested at $75,000 and have grown to $150,000 is to show you that any capital gains on that money is what's going to be left going through the estate. Effectively, it's a deemed disposition. It's as if you sold the investments at a gain, and that capital gain has what's created the $17,887 tax bill. So really, when you look at this, there's 4 asset classes, and it's only really 2 of them that have created the tax bill. Now, again, this doesn't include probate. This is just estate taxes. So for anybody who's not clear about what probate is, well, we're talking about guarantees, right? Death and taxes. Probate's kind of like a third guarantee. It's a death tax. This is why I have no friends, because I talk about this kind of stuff. Probate is essentially just the cost of taking your will through the court system to make sure that it is in fact valid. So it's not too much. It's about 1.4% in British Columbia, but it does apply to all the assets that are left inside the estate. So that should give you some idea as to how those, say, 4 particular asset classes are taxed. But what happens if we have even a more simplified estate moving forward? I want to show you an example as to how even the most simplified, dumbed down sort of estate can still create some potential problems. And in this example, we have a well-intentioned mom, Wendy, who has 2 children, John and Jen. And for her, she has 2 major assets. She has an RSP worth $350,000, and she has a cabin worth $350,000. Wendy knows her daughter Jen loves the cabin. She likes to go there in the summer, really enjoys the lake. So she decides she's going to leave the cabin to Jen. $350,000 asset, off it goes. John, he likes to spend money like it's going out of style. So Wendy says, you know what? John's going to get the $350,000 RSP. That way he can spend to his heart's content, and John will be happy. Not bad, right? 2 assets, both worth $350,000, leave 1 to each kid. Wendy thinks she's done pretty good. She's done a good job, right? Well, based on the name of this slide, you know that there's a sideways coming. There it is. John gets the $350,000 in the RSP in this example, and he goes off to Vegas. We'll see John in a few days. Jen, she gets the cabin worth $350,000, but she also gets a $140,000 tax bill, and she can't pay that. Well, where did the tax bill come from? If we think back to that first example, the RSPs passed directly to John, directly. However, Wendy had to declare $350,000 in income in her final year, and that created the tax bill for the estate of $140,000. So the estate is on the hook for it. And what's left in the estate? It's the cabin. So basically, Jen has to sell the cabin if she can't afford the $140,000 tax bill, and she's left with $210,000 of the estate, whereas John got $350,000. So already there's some discrepancy between the two. At worst, immediate family can always contest the will as well. So if John's really feeling like a jerk, he can actually go back and contest the will and really kind of put Jen into a bit of a bind. So again, this is a situation where Wendy has 2 assets. She thinks it's as easy as leaving 1 to each child and all will be well. It's not necessarily the case. It's very important to know how all these assets will be taxed. So again, when you're thinking about your estate planning, your will, these are some of the things you should be considering. Estate taxes. A will alone cannot necessarily protect you from estate taxes, though it's an incredibly valuable tool and everybody should ensure they have one and it's up to date. But the will can be contested, so there's a contestability issue. That's the old saying, where there's a will, there's a relative. I'll pause for laughter. I'm assuming it wasn't much laughter. Okay, moving on, what can we do about this? John, you've bummed us out. You've talked to us about death and taxes. We're all going to die. We're all going to have to pay taxes. What can we possibly do? Well, there's a few things. Of course, you can always introduce permanent life insurance, and it can be used in several different ways. What's great about permanent life insurance is it's like a tax-free savings account, a tax-free benefit with a named beneficiary. So it never makes up part of your estate. It's not subject to estate taxes, nor is it subject to probate. It can pass directly to the beneficiaries themselves. In our last example, where we had John and Jen, we can see why that might come in handy. If Wendy has an insurance policy worth $140,000 with Jen named as the beneficiary, well, upon Wendy's passing, Jen will get $140,000 tax-free and the cabin. If the estate still owes $140,000, the life insurance can pay that tax bill, and Jen does not have to sell the cabin. Also, if you're getting a life insurance policy to pay the estate taxes, to pay the probate, you can imagine you can actually keep more of your estate intact because you don't have to use any of it to pay these tax bills. As well, if anybody has, in the first example, a non-registered investment account and they have a permanent life insurance policy that allows it, what they can do is they can actually take portions of this non-registered account and move it into the permanent life insurance policy every single year. And why would they want to do that? They'd want to do that if the goal was to ultimately leave that money to their beneficiaries, children, whoever that may be. Because, as we looked at in that first example, the non-registered money, when just left through the estate, is subject to possible estate taxes and probate. Whereas if you were to slide that money into a permanent life insurance policy, it will now get passed to the beneficiaries directly outside of the estate and no longer subject to probate. So it can give you some flexibility in that respect as well. Finally, you may end up deciding that, you know what, I'm going to get a life insurance policy and leave that to a charity because I'd like to do some charitable work upon my passing. That's a great idea as well. In this example, if Wendy gets a permanent life insurance policy, names the charity as her beneficiary. Upon her passing, the charity will receive the benefit, lump sum, tax-free, no estate tax. What does happen, though, is that her estate will get a tax credit, a charitable donation tax credit, and that can be used to help offset some of the tax that the estate would otherwise owe, effectively keeping her estate intact. So again, not to bum everybody out, there are solutions on the other side, but just some things to think about. When you are coming up with your estate plan, drafting a will, things like that, just be cognizant of how your each asset class will be taxed. And if you do want to know more about it, please feel free to give our office a call. You're always welcome to talk to me about death and taxes. I'm kind of like the Maytag repairman. I don't get a lot of phone calls, so I'm always welcome to talk to you. We'd be happy to help you out in any way, shape, or form, and I really hope that today was informative. I know it's a quick introduction to this stuff, but hopefully it plants some seeds and gives you a chance to really hone in on some of the things that you'd like to get done for your estate plan. Thank you, and we'll talk to you soon.